Welcome back to Principles of Costing. In today's session, we are going to look at material costs. We recall from chapter number 2, material cost is one of the 3 elements of costs. We had 3 elements of cost: materials, number 2, labor, and number 3, expenses. So we are in the first element of cost, which is called material costs. Now, what are materials? Materials are physical inputs to a production process. Physical inputs. For example, when you are making a chair, what are the materials to make the chair? There is the timber, there is the metal, there is the oil that was used in varnishing the chair, etc. Physical inputs to a production process. There are 3 types of materials we need to know. We have what we call raw materials, work in progress, and finished goods. So when we talk of raw materials are the components that are incorporated into a production process, plus all the consumables. Anything that we input into a production process. For example, in the chair, we input timber. So timber is a raw material for making a chair. Number 2, we have work in progress. This is a stage that is not complete. Items of which manufacture has begun but has only been partly completed. A job that is not complete is what is known as work in progress. And finally, we have what is called finished good. Finished goods are now the materials that are ready for sale. They are products that have been finished, ready for sale, plus bought in goods purchased for resale. So if you are buying and selling, they are goods that have been purchased for resale. So there are 3 types of materials: raw materials, work in progress, and finished goods. Those were types of materials. But we also have what is called classification of materials. When we classify materials, materials are classified into 2 groups. Number 1, there is what we call direct materials, and number 2, there is what is called indirect materials. So what are direct materials? Direct materials are the raw materials from which the product is made. Direct materials are materials traceable to a specific cost unit. So if we are talking of the chair again and the tables, the timber is a direct material, the material from which the product is made. If you are making the chair, what is the material that is used to make the chair? It is the timber. So timber is a direct material, physical inputs to a production process. On the other hand, indirect materials, they are materials, yes, but you cannot see them in the final product. They are materials not traceable to a specific unit. They are consumable. Consumable is the key word. You cannot see it in the final product, yet it was used. For example, in the making of the chairs and tables, there is some grease that might have been used. Grease. There can be some nuts that were used to adjust the timber to the metal, but you cannot see it. It was consumed. So those are indirect. The next area, after looking at introduction, types of materials, and classification of materials, number 4, we want to look at 3 important records in the chapter materials. And the 3 records are inventory cards, store ledger accounts, and material requisition. Let's start with inventory cards. Now, inventory cards are manual records that are written and kept in the stores department. Remember, stores is where the materials are kept. So when materials are purchased from suppliers, they are kept in the store, and where the documents are kept, where we record the documents that were brought in, plus all the details, it's called inventory card. The key point, it's kept in the store. Inventory cards have got quite a number of items within them. In an inventory card, you will find 5 items. Number 1, you will find a description of the inventory item for which this is a record. There will be a description that this is timber, and this timber will be used to make chairs. Number 2, there is what we call inventory code. And a code is just a unique number that is used to identify a particular material. Codes can be numeric, they can be alphabetic, or they can be alphanumeric. So if we talk of numeric codes, these are codes that are in numbers. When we talk of alphabetic codes, these are codes that are in letters. And if we talk of alphanumeric, this is a code that combines numbers and letters. So inventory code must be there. The third item that must be in inventory records is inventory units. What is the form of measurement of inventories? For example, timber can be measured in kgs, or it can be measured in meters. Some liquid water can be measured in liters, in milliliters. So that is what we call unit of measurement. You must give the unit of measurement of materials. Number 3, inventory number. Why is it important to number the inventory? So that when you go to the store, you can locate it. You will know that inventory number 1 is in a certain corner, and inventory number 2 is in another corner. So inventory numbering is important for the sake of identification of where the inventory is located. The fourth item is inventory control information, or what we call stock levels. What is the maximum level of stock that we should have in store, and what is the minimum level of stock we should have in store? And at what point should we call suppliers to bring in new orders, what we call reorder level? And lastly, issues to the production. What quantity do we send to the production? The second document we need to know is what is called a store ledger card. Remember, inventory cards are kept in the store. But when you talk of store ledger accounts, these are the same. It's a reflection of the same items in inventory card, but they are now not kept in the store. They are kept in the accounts department. The contents are the same. They carry all the information that inventory card does have and are updated from the same source, but they are kept in the accounts department. So that is the second one. The last document we need to know is called material requisition. Now, requisition is done from the production department to the store. When the production department needs some goods, they place a requisition with the store. Where those items are recorded is called material requisition. So material requisition is just the process of trying to order materials from the store to the production department. It's the duty of the production department manager to place a requisition. Now, why do we need material requisition? Number 1, it helps in updating the inventory card in the store. Remember, inventory card is kept in the store, the first document we looked at. Number 2, it helps in updating the store's ledger card in the accounts department. The second document was being kept in the accounts department. And number 3, it helps in charging the job, overheads, or department that is using the matter. When we want to charge a particular job, we refer to the material requisition. So, the last part, which is the widest topic materials, is what we call inventory valuation. Where there is the word inventory, you can use the word materials or you can use the word stock. So we can also refer to these as stock valuation or material valuation. So what is valuation? Valuation is the process of trying to determine the worth or the value of the material that is in stock. Stock valuation is the process of determining the value of stock issued to the production department from the store. When you want to value stock, there are three methods that can be used to value stock. The first method is known as first in, first out. In other words, the first goods that came to store are the first goods to be issued out of the store. That is called first in, first out. It's normally abbreviated as FIFO. The first goods that came in are the first goods to be issued out. Number two, there is what we call last in, first out. The last quantity that came in is the first to be issued out. And the last method is average cost method. In other words, it does not look at what came in first and what went in last. It calculates an average price, what is called an issue price. So issue price is the total value of stock held divided by number of units of stock, divided by number of units of stock. So in order to value stock, there are three methods that are normally used. Number one, first in, first out. Number two, last in, first out. And number three, weighted average cost method. So in order to look at the three methods, to look at the similarities and the differences, it's important to focus on examples. So let's look at example number one. In our example number one, it's a long question. The objective of these is to know what is the final value of inventory after all the receipts and issues. So let's read through this question. ABC Limited has the following transactions. 1st January, opening inventory was 600 units at 300 per unit. On 5th January, they purchased 1,800 units at 400 per unit. On 8th January, they purchased 2,200 units at 500 francs each. On 15th January, they sold 4,200 units. On 20th, purchased 3,200 units at 600. On 28th, purchased 2,100 units at 650. And on 30th, they sold 5,400 units. Required. Prepare a stock ledger card to show the units and value of closing inventory on the 30th of January. In other words, when you want to know the value of inventory, we prepare what is called a stock ledger card. Now, a stock ledger card is a document that summarizes all the quantity of goods that came in and what was issued to give a balance. So there are three methods we are going to use there. The first method is called first in, first out. The second method is called last in, first out. And the third method is called weighted average cost method. So we are going to look at first in, first out. So in a stock ledger card, there is a column for the date of the transaction, the details of the transaction, the receipts, what came in or what was purchased. There is the issues, and there is the balance after accounting for the receipts and the issues. So let's start with the first date. First in, first out. The first date was 1st January. Now, on 1st January, there was opening inventory. So details, we will post opening inventory. What was the quantity of opening inventory? 600 at 300. So opening inventory is not a receipt. It is not an issue. Opening inventory is a balance. So you come and post 600 units. 600 units, and the price was 300. So 600 times 300, it is 1, 0. How many zeros? 0, 0. 1840 zeros. So 1840 zeros. 0, 0, 0, 0. So that is the opening stock. We have posted that opening stock is not a receipt, it's not an issue. We are done with that. We go to the next date. The next date is 5th January. We purchased 1,800 units at 400. So on the 5th of Jan, it was a purchase. We purchased 1,800 units at a price of 400. 1,800 at a price of 400. Let's look at our calculators, and everyone should be using their calculators. 1,800 times 400, it gives us 720,000. 720,000. Now, when we purchase stock, when we receive stock, it increases our balance. So we have 600 plus a new stock of 1,800. That gives us 2,400. Our amounts are also increasing. 180,000 plus 720,000. So that gives us 900,000. So that is 5th January. The next date is 8th January. We again purchased 2,200 at 500. So 8th January, we purchased again. We purchased 2,200 at 500. So we have 2,200 times 500, and that gives us 1,100,000. 1,100,000. Again, purchases are receipts. They increase our balance. So 2,400 plus 2,200, that is 4,600. And we have now 900,000 plus 1,100,000. That gives us 2 million. 2 million. Okay. So we are done with that particular transaction, that date. We go to the next date. Now the next date is the most important. We issued. Now these are the first batch of issues. On 15th January, we sold. So 15th January, we now sell. Sales are issues. Now when you are issuing, we sold 4,200. But we are using the principle of first in, first out. First in, first out. Now in first in, first out, we want to sell a total of 4,200, but what we have is 600, 1,000, and 2,800. So you will first of all issue the 600, and when I take 4,200 minus 600, I'm still left with 3,600 to issue. And I'll issue it at the price of the 600. The price was 300. So I'll issue these at 300. I was to issue a total of 4,200. I've issued 600. I've finished this stock. The next stock is 1,800. So I'll come and issue 1,800. At what price? 400. I'll remove the 1,800 I've issued. I'm still remaining with another 1,800. So the 1,000, I've finished these. The last 1,800 will be issued from this batch of 2,200. So 1,800. It will be issued at a price of 500. So we have 600 times 300. It gives us 180,000. We have 1,800 times 400. It gives us 720,000. And we have 1,800 times 500. It gives us 900,000. So that is what we have under that date issues. But to confirm your figures are accurate, you add 600 plus 1,800 plus 1,800. It should give you a total of 4,200. Now let's reduce our balances. So we have 4,600 minus 600. 4,600 minus 600, it gives us 4,000. Take note that issues reduce the balance. So 4,000 minus 1,800, it gives us 2,200. And 2,200 minus 1,800, we are left with 400. We go to the amounts. The amounts, the first one is 2 million minus 180,000. It gives us 1,820,000. 1,820,000 minus 720,000. It gives us 1,100,000. And 1,100,000 minus 900,000. It gives us 200,000. 200,000. So that is what we have on that date. So if you are asked, what is the value of closing stock on 15th January? The units are 400 and the value is 200,000. We go to the next date. Our time is winding up. So we have 20th January. We just continue with the same process. We purchased 20th January, we purchased 3,200 units at a price of 600. So 3,200 times 600, we should now be faster because we have already done the first part. 1,920,000, 1,920,000. That is what we purchased. We don't have issues on that date. So 400 plus 3,200 is 3,600. 200,000 plus 1,920 plus 200. It gives you 2,120,000. We are almost there. On the next date is 28th Jan. Again, we purchased. We purchased how many? 2,100 units at a price of 650. So 2,100 times 650, it gives us 136,500. Our balance is 3,600 plus 2,100. It gives us 57. And we have 2,120 plus 1,365. It gives us 3,485,000. As we wind up, the last date is 30th January. Now, in 30th January, we sold. There are sales. Again, in 30th January, what happened? We sold 5,400. It's our last item. So 5,400, there was 400 that remained from here. So we will issue 400, which was remaining at 5. We have exhausted now that. We come to this 3,200 at 600. And let me see the balance. 5,400 minus 400 is 5,000. Minus 3,200 is 1,800. The last value is 1,800 will be picked from here. 650. So as 400 times 500 is 200,000. 3,200 times 600 is 1,920,000, and 1,800 times 650 is 1,170,000. And finally, we now get the balances. 57 minus 400 is 53. 53 minus 32 minus 3,200. 53 minus 3,200 is 2,100. And 2,100 minus 1,800 is 300. The same for the amounts. 3,485,000 minus 200,000 gives us 3,285,000 minus 1,920,000. 1, 2, 3. It gives us 1,365,000 and minus 1,170,000. It gives us 195,000. And the conclusion is, on the 30th January, we have a stock of 300 units remaining, and the value of stock is 195,000. So that is stock valuation using FIFO method. In our next session, we will look at last in, first out. Last in, first out. Let's have a break at that. In our next session, we look at last in, first out. Thank you for your attention on first in, first out.